Kazaure Limited. Kazaure Limited has a cash surplus of 20 million. Now, I want to ask this question. When you see a question in performance manage in SFM, what will you do first? What is the first thing you need to do?
You read the requirement.
Thank you. That is a very good one. You read the required. Read the required. Understand the required. Don't forget all these things. They are very important. If you read the required and understand the required, right, it is assumed that you've solved 60% or 70% of that question. Because understanding the requirement will just give you, you can just use maybe 15 minutes for that question because you already understand what they say you should do. Please, this is very, very important. Don't just rush. You want to read question, right? No, read the require. You can flip through all the questions. Okay, this is bond. This is valuation. Okay, this is this. This is free cash flow. Okay, just flip through and understand the required. Then you now choose. Okay, let me. Okay, you need to do the 30 marks question first before the 15 marks. Right now, let's quickly look at this question together. Okay, Kazauri Limited has a cash surplus of 20 million which the financial manager is keen to invest in corporate bonds, right? The financial manager is now keen to invest this 20 million in corporate bond. He has identified two potential investment opportunities in two different companies, which are both rated A. You can see that they have been rated by A, right? They are considering alternative investments, and this has been rated as what? As A by the major credit rating agency. Bond A. What is bond A? Now, bond A, the issuer plans to raise 500 million. Class, who is the issuer? Who can tell me who is the issuer? Who is the issuer?
It's the company.
What are they called?
It's not the bond holder. They're the bond. So bond taker, no?
Well done. What are they called? The issuer.
Bond issuer.
Bond issuer. What are they called? There's a name.
Valuer. Is it No, 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 no.
They are called borrower, right? When you see a company that want to raise a debt instrument from the general public, right? They are called the lender, the borrower. I've explained this in the previous lecture. You that you want to buy the bond, you are the lender because you want to buy part of their bond, right? The issuer is like the borrower, right? It is not like the borrower, it's the borrower, right? Now, the issuer plans to raise this. Of course, Kazari Limited, they have surplus cash and they've identified two different companies that are rated A. Now, they have the first bond A, right? The issuer is planning to raise 500 million with a coupon rate, which is the interest rate of 10%. The bond is redeemable at premium. Now, class, when a bond is redeemable at premium, what does that mean?
It will have a higher repayment amount. You add the 8% to the coupon amount.
That is the textbook explanation. I need practical.
Value.
Ayola, I'm listening.
A premium is an amount higher than the par value.
Okay, it's higher than the what? That
Like
higher than the par
premium is
value, right? Higher than the par value, which indicates that we are paying you excess of money. Why are we paying you excess? Is because you are taking a risk to invest in a risk what? We will pay you excess as a result of investing in a risk what? In a risk asset. That is the issue of that premium, right? That is the issue of that. So this particular bond for bond A is at premium. The bond is at what? Is at premium, right? To nominal value, right? To what? Nominal value. Don't forget, I've mentioned this, that when a nominal value, your nominal value or your face value or your par value is 100, when it is stated in the question, maybe 1000, you use the 1000. When it is not stated in the question and they just say nominal value, it is assumed to be 100. Or if they say par value is assumed to be 100 as well, right? Now, the B part of this question now, oh, bond B, the issuer to raise 800M 3-year bond with a coupon rate of what? 12%. With what? With coupon rate of what? 12%, right? Now, and redeemable at par. Par means 100. It means that when they want to redeem it, this is a redeemable bond. When they want to redeem it, they will redeem it at par. Par means 100. I've explained this in the previous lecture, right? Now, the annual spot yield curve for government bond, you can see the annual spot yield curve for government bond, which means that yield curve class, yield, return. Now, the government bond, the annual government yield curve for year one will give you 9.50%. Year two, you can see that as the year is increasing, the government bond is kind of increasing, but the increment is not, it is not that significant. Let me use the word, right? It's not that significant. It's just like when you see a company financials like that, right? Now, extract from a major credit rating agency website. Extract from a credit rating agency. So table or spread. Now, when they say something is in basis points, what does that mean? Basis point means is in percent, is in a percentage. When we get to adjusted present value, you will still understand, you will see more of basis points. Class, so basis point means 100, is in percentage class. When they give you 6, it means it's 6%, right? That is what it means. Now, don't forget that the company is rated AA, is rated A. At the beginning of the question, they said these two companies are rated A. Is that not so? Then you are given the credit rating A 20, this is 30, right? And this is what? 50. Now, look at it. Compare it with this. Compare it with government yield. You can see that this is 9%. Which one is higher? You can see
The,
which one is
the,
higher?
the
Class, which
basis
one is
points.
the basis point, which is like
Yeah.
a private bond, right? Which is like a corporate yield. Is that not so? Now, what it means is that you can see that the government yield, you can see the practical illustration now. You can see the practical illustration. The government yield is increasing, but not that significant than the corporate yield. You can see that when it is rated AA, the basis points, the return is 10, 20. From 20, it increased to 30. From 30, it increased to what? 50. Now, required. Hmm. Sorry, please give me a minute. Thank you. Okay. Okay, quiet. For a nominal value of 1,000. Oh, it is even stated here. For a nominal value of 1,000, which means your nominal value will be 1,000. You can see, I said, read the required, understand the required, then you move from there. Calculate the theoretical issue price of the two bonds and indicate how many of each of the bonds Calzare Limited can buy, assuming it invests in only one of them. Calculate issue price to the nearest thousands. Class, what is theoretical issue price?
It's yield curve plus the basis point.
Who is that?
Chimobi.
They play. You
That's the
see,
market price.
Sorry.
just,
It's
just,
it's
just they play.
it's after calculating, after getting your yield to maturity for each year.
So the theoretical issue price is the bond valuation, right? The theoretical issue price is the market value of a bond. Class. The theoretical issue price is the market value of a bond. Then when you want to determine the market value of a bond, you need some ingredients. Now we'll start from there. And that is how to interpret question. You see, SFM is very simple. You see, understand the required. Once you understand, you can see now, we already understand that, oh, theoretical issue price, oh, market value of a bond. Then ask yourself, if I want to determine the market value of a bond, if Abdurrahman or Aishat want to cook soup now, you will say, I will need salt, I will need maggi. So what are the ingredients you will need to cook this soup? That is why we are, yes, you ask yourself, oh, what are the ingredients? Oh, I need this, I need that. Then you go to the question and check, okay, where is this figure? Is this given in the question? Is this given in the question? And that is how to solve, that is how to, 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 to tackle SFM. Very simple. Please understand the word they require. It's very, very what? Important. Now, B, irrespective of your answer in A, assume bond A is issued at the issue price, which is the market price. It's issued at 1,504, 1,054, and bond B is issued. See, you can see another name that they give you. They say, and bond B is issued, right? So you can see they can call it any name, right? This issued is the market price. It's given that this is the market price or the market value of the bond, right? Calculate you can see what I'm talking about, right? Calculate the yield to maturity at the time of issue. You can see you cannot have two unknown, right? They have given you the market value or the market price. For you to determine the yield to maturity, what are the ingredients you need? This is, how many marks is this? Okay. I think there should be a mark there. There should be mark. The total marks is 20 marks, sha. Next, calculate the duration of each bond. What does duration measure? You can see, you can see another question here. What does duration measure? It measures what? Who can tell me? Duration measures what?
It measures the the period of completion uh, of repayment
Payback
of
period.
Okay, payback period. Thank you. Another thing is that if you watch that video, the previous lecture, I said duration of a bond is the average life of a bond. In other words, duration of a bond is payback period. You cannot still explain further that duration measure the time an investor will recoup back its investment. Class. You can see it is different from theory. You add theory with practical. Assume you borrow money. What is the duration? It's the time you will use to recoup back your investment, right? The person that mentioned duration, payback period, well done. Chimobi, well done too. Now, if you expect interest rates to increase in the market, which of the bonds, A or B, would you like to buy and why? No calculation is required. This is 20 marks total. Now, quickly, we'll end this class because we'll end this class by this is 10:18, right? This is 10:18. So hopefully we'll end this class maybe by 10:40 so that we can go and rest, right? By 10:40. Okay, this is 10:22. Wow. Okay, let's see. Let's see. Interesting. Let's suggest a solution. We may not we'll continue tomorrow. It's not a problem, right? It's not a problem. And again, for your please, I will combine both bond valuation. I don't have a note on bond valuation. Please go and watch the previous lecture on bond valuation so that you can be able to uh pen down some important points from there, right? Right, it's very important. Another thing is that I will join the notes for bond valuation and portfolio theory together. I will join the two. I will join the two. So I will send it across for those who are actually buy the material, right? Now, suggested solution. Suggested solution. I have about 5 questions, but we'll just solve 2 questions. Then the other questions is for you. So now, class, theoretical issue price. A. Theoretical issue price. Now, I need to call someone to tell me if I want to cook soup now. What are the ingredients? What are the ingredients I need to know? Someone should tell me the
You need the
ingredients.
detail, the cash flow, the discounted cash flow, then the present values.
Okay, oh, thank you.
Interest rates, number of years, nominal value, yield to maturity.
Thank you. Oluwapemisire.
Good evening and thank you for the lecture. Please, I want to snap the picture. I want to snap the question, sorry. You can come to the face of the question.
How much will you pay me?
Sorry, so that I can go along with you when you are solving.
Okay, that's fine. That's fine.
Okay, is it the beginning of the question? 1A?
The first one is not that important, so that is why I said because you can start from that side.
Thank you. To the next page, please.
You coming?
Thank you. To the next page.
So you can flow now, right? You can flow. So now, if you want to determine the theoretical issue price, right? Theoretical what? Issue price. The theoretical issue price is the market value of a what? Market value of a bond, right? The first thing is, what is the market value? Okay, no. The cash flow, right? The interest, the numbers of years, yield to maturity, right? Yield to maturity. You need this, right? Now, the question now is, we'll start with bond A, right? The question now is, the yield to maturity class is not given in this question. yield to maturity is not given in this question. Now, when you want to determine yield to maturity, you still need market value. But since credit rating is given to you in the question, you can use the credit rating, right? Both the government and the corporate bond, corporate yield, the corporate yield and the government yield will give you the yield to maturity. You don't need to stress yourself, class. You can use this to get your what? Your yield to maturity, because it will be like the return on the what? On your investment, right? Now, in this case now, let's go there. Okay. Let's start with bond A, right? Bond A, right? So let's go there. Let's take what is the interest rate? The interest rate for bond A is what? Is what is the interest rate, class?
10%.
So this is
10% for
coupon.
bond.
This is coupon. Oh, coupon means interest rates. Before, I know some students will go and use 8%. That one they sure. Uh, so please, coupon means interest what? Interest rates, right? So the interest rate is 10%, right? Now, don't forget that the nominal value, you can you can see that the nominal value is 1,000. You can see, can you see it? It's stated here. But assuming it is not stated, you can quote 100 naira as the nominal value. Is allowed, right? Is allowed. Now, in that case, the interest is 10%. If I want to get the value of the interest, I will say 10 divided by 100 times what? Class. 10 divided by 100 times what?
1,000.
Times 100.
Times
Times what?
1,000 this time.
Times one
1,000.
times 1,000. Why is it times 1,000? Because you want to get the
To give
value,
us 100.
yeah, the value of the interest, right? Times the 1,000. You multiply by the nominal value, class. So this will be equals to what? This will be equals to what?
100.
100.
100. So 100. So what is the numbers of years?
1, 2. 2
2
years.
years. 1 and 2.
I need to confirm. The numbers
It's
of
2 years.
years. Okay, it's 2 year, right? So now I want to determine the yield to maturity, because the credit rating is given already. So you can use that to determine your yield to maturity. So you could say the government yield plus Timobi, mute your mic, plus the corporate, or you can say credit rating. You can use credit rating, or you say the corporate yield, right? I just use corporate yield to so that you understand that is like a private what? Private yield. Because when you look at it, it's higher than the what? The government yield. That is why it is called private yield, right? Is equals to yield to maturity. So we start year one. We start on year one. Benjamin,
Yeah, sorry, I'm dragging us back, please. Please, how did we arrive at that credit rating A for this bond A?
credit
Was
rating.
it
Which one?
stated
Is it this?
in
Is it this?
I heard you mentioning credit rating A for bond A. So I don't know if it was stated anywhere categorically in the question.
Is there. Is there. We'll get there. Don't worry. Don't worry. You see it. You see
All
it.
right.
Don't worry. It's there. So for you to get your yield to maturity, your government yield plus the credit rating or the corporate yield will be equals to yield to maturity. Why? Because the credit rating is given to you in the question, class. So we start year one. Year one. So we need to look at what is the government for bond A. Let's quickly check. You can please screenshot this part. Okay.
9.50.
I'm coming. I'm coming. Please screenshot this part. Are you there? Okay. Screenshot this as well. Don't forget that it is AA we are using. Why are we using AA? Because the credit rating is AA. At the beginning of this question, we were told that the two company is rated as what? AA. A what?
A.
A.
Not
A.
A.
Sorry. It's rated A. Thank you. So in this case, now, what do we do? So the government yield, what is the government yield for year one?
9.50.
9.50%. You convert the first one, convert it. What do you have? Plus,
0.20.
okay, plus, what is the other yield? Is 20, right?
Yes, 0.20.
Though, what do you have when you convert? What do you have?
9.
What do you have? I'm coming. Mm,
9.70%.
I'm coming. Hold on.
What should be 0.20?
There's a law here. I'm coming. Let me just try to check something. 3.3 plus 0.7. Okay, there's a law here that we need to follow it. 3.3. Okay. So now here is the rating exclusive.
So but for this
Right.
bond, the rating is AA now.
Uh, so what happened?
But is it not 15% for AA?
Is it
No,
AA
like
or
it's
A?
AA now. There are three ratings: AA, and A. Right?
So
Victor,
You
what
said
is
it's
the
AA
rating
now.
given to us in the question? Is it not A?
I don't have the question. What I'm saying,
A, sir.
sir.
The question.
Okay, it's A. Sorry, I don't have the question. I didn't say yeah.
Exclusive, you will say
Thank
you
you.
don't have the question. That is what you will say.
No, I said it though. I said it. I said I didn't have the question. I said I didn't have the question.
Sir, I
Sorry.
thought we were going to reduce the percentage to 20% before adding.
No reduction. Class, the government yield, right? What is the government yield? Is how many percent? The government yield is how many
9.50.
percent? 9 point what?
50. That's the one
Good.
you wrote.
That is the one I wrote. That is a very good one.
Uh,
Now, the other one is what? How many percent is that?
20%. That's what I
20
was
20,
basis points.
saying.
20%, Abby. Now, there is a law
Yes,
here
sir.
that
Yes.
exists, class. Please, hello. There is a law here, right? So when you want to do something like this, right? Now, the government yield is 9 point what? 9.50. Is that not so? Now, the second one is what? Um, is 20. Basis point is in percentage, right? Now,
Yes, sir.
what the law says here is that what you need to do is that this one will be 9.5. Then you can convert this. Hello, who is that now? Mute your mic. So convert this 20%. If you convert it, we give you what? 0.
0.20.
0.2. 0.2, right? So you will now say 0.2 plus 9.50. What do you have?
9.70.
9.7 what? 9
0%.
point. 9.70%. And that is what the law says, right? Whenever you are given something like this, your government yield will remain 9.50%, 9.50 plus the credit rating, because the credit rating is based on the basis points, right? Stated in the question. You convert it. 20% is 0.2. Add it with 9.5. That is what the law says, right? Isaiah.
Yes, sir. I actually didn't really get. I thought we had to convert 9.50, but it's like you've
No,
explained it just now. We'll just leave it the way it is. Then we'll convert the 20% since it's in
thank, thank you,
basis points, right?
thank you, thank you. That is why I said there is a law here that exists, right? That the government yield is assumed that it has already been converted, right, before they arrive at 9.50. Why? The basis point, right, which is the credit rating, it is yet to be converted. And that is why you see basis point 20. 20 means 20%. Convert the 20% and add to the government yield. Then you move on. Now, if this is established, right, so you can still convert this 9.70%. What do you have? Divide it, you have 0. What? What do you have? You have 0. What? You have 0.
0.97.
0.097.
0.097. Sorry.
Okay.
Yeah, I think it's just that credit rating that has to be done because it was stated in basis points. And basis point has to do with that figure given over 100, but the answer will still be in percentage.
That's what we are doing.
Okay. Oh. Now, we've done the year 1, right? Now, we move to year 2. Please pay attention. We move to year 2. Year 2 is what? 10.40. It is assumed that it has been converted already. The government yield has been converted. So that is when we have 10.40. So in this case now, we will not convert the 10.40, but we will always convert the credit rating. What is the credit rating? The credit rating is what? 30. That is 30%. So give me figure. So I will move on. So what is the government yield for this? What is the government yield?
10,
10 point,
0.40.
10 point what?
10.40.
Point
40.
40 plus, right? What is the percentage? 30%,
0.03.
right? That is why I always
0.3.
thank you. That is why I always do it like this, so that you will know that we converted it 0.3. So when you add it, we give you percentage, right? What do you have?
10.70.
10.7.
10.70.
70.
10.7.
Okay, 10.07%. So you can convert this. You can convert this. Why am I converting is because I will use that conversion as we move. Right? That is why I say, okay, just convert so that we just get it once and for all, then we move on. Please, what do you have? This is 0. What?
0.107.
107. Right? So year 3, what is your year 3? What do you have in year 3? What is
No,
the
this bond
government
A
yield?
doesn't have year 3.
Oh, doesn't have year 3. Oh, that's fine. That's fine. Thank
Yes,
you for
bond
that.
A is 2
Okay.
years. Yeah.
Okay. Okay. Now, class, the yield to maturity. We've gotten the yield to class. Pay attention. We've seen the yield to maturity, right? For year 1, because the credit rating is given, right? And for what? And for year 2. Next, we need to tabulate it as usual, right? So we can have year, items, cash flow. Please always write it in full. Cash flow, right? BCF. Please, you use yield to maturity to discount. Let open bracket YTD. Use the yield to maturity to discount. The next is present value. Benjamin, sorry. Benjamin, are you still with us? Okay. Benjamin, present value. Present value. Right? So, what is the cash flow? Then we move here. Sorry, I'm supposed to put the sign.
100 for your one.
Okay, I'm coming. So the interest based on now it is for how many years? It's for 2 years, right? Which means that you will pay interest for 2 years. Is that not so, class? So it will be from year 1 to year 2. So we can have interest. The cash flow is 100. Please, you use the yield to maturity for year 1 to discount. So how do we do that? 1
1 plus
divided by Chimobi.
Hello, sir. I think since their credit rating is different, are we going to still use annuity for them? For the
Oh,
two?
their credit rating is different. Oh, thank you. So year 1, thank you. Because they are not even their credit rating, you can say their yield to maturity is different from each other. You can see that the yield to maturity for year 1 is 0.97. The yield to maturity for year 2 is 0.1070. So we can't say they pay interest from year 1 to year what? Year 2, because they have different yield to what? Yield to maturity, class. Right? Now, in this case, so what do we have? So divided by 1 divided by our DCF class 1 plus. Now, what is the yield to maturity for year 1? You can see it here. Plus 0.097. You close the bracket. Then the raised to power, the numbers of years is 1. You raise this power of 1. You have your figure. What do you have, class?
0.912.
No, multiply by 100, okay? Okay, 0 point, let me,
91.2.
okay,
91.2.
I'm coming. 0 point what?
912.
912.
912, okay. So multiply by the present value. What do you have?
91.2.
20,
91.2.
okay, 91.2. Okay. So year 2, interest, right? The interest is 100. You still pay interest in year 2. Now, don't forget that. Okay. Now, let's quickly go back to the question. I think they mentioned something here that I didn't take into consideration. Now, the bond is redeemable at a premium of 8% to its what? Nominal value. And we already know that the nominal value is what? The nominal value of the bond is 100. Is that not so? But 1,000 naira is given to us in this question. That the nominal value is what? 1,000. Class, the question says that the bond is redeemable at a premium of 8% to nominal value, which means that if nominal value is 1,000, we need to add 8% to it. That 8% is as a result of the risk that you actually, it's just like the risk that you engage, or how should I put it? Just like what they will compensate you for investing in that particular risk asset. Class, the nominal value is on 1,000. The premium, what it means is that the nominal value will be higher, or the 8% will be added to the nominal value. That is what we call premium, right? That is what we call what? Premium. The nominal value, the market, yes, that is what we call premium. The 8% will be added to the what? The nominal value. I'm looking for another way I can actually explain that, right? Now, in this case now, for my ingredients, did I actually include the nominal value? I didn't include nominal value, sorry. Nominal value, right? Now, don't forget that the nominal value is 1,000 naira given to us in this question. But there is a premium. The question says nominal premium of how many percent? What is the premium? The bond
8%.
is redeemable at a premium of 8%. What it means is that we are adding 8% to the nominal value. To the what? Nominal value. That is at premium. It is above, right? Which means that this bond is above the market, is above the nominal what? Is above the nominal price. That is what it means. This bond is above the what? The nominal price. And premium is when the market value is higher than the what? The nominal price or the nominal value. So this premium that is here, it means that we will add the premium to the nominal value class. And that is what makes it what? Premium. So we can come back and say, because there is premium there, you can say nominal value plus premium.
Also, we can say redemption value.
Right?
Yes.
Right? So we can as well say redemption value, right? We've done that in the previous lecture, right? Now, the nominal value plus the premium. What is the premium? The premium is 8%. Is that not so?
18 naira. Yes.
Is 8%. Is that not so? Now,
Yes, sir.
how do we convert the 8% to naira? It's just the usual way. Is that not so? Now, or let me separate this. For those who are just joining us, let me separate it. This is nominal value, right?
Yes.
Then if you want to get your premium, please mute your mic. If you want to get your premium, right? The premium is 8%. 8 divided by 100, right? 8%, 8 divided by what? 100 times the nominal value, which is what? 1,000. This is 80 what? 80 naira, right? Class, are you there? This is the nominal value, and there is a premium of 80 what? 80 naira. Class, are we still together? Okay, there's a premium of what? 80 naira, right? Now, in this case now, class, we can go back. Come in. Where is our table? Okay, this is it, right? 2, 1 divided by 1 plus 1 plus, what is the yield to maturity? This is the yield to maturity, right? That is the yield to maturity, right? 0.107 raised to power 2. Raised to power of 2. Now, class, don't forget all this because I will receive interest from year 1 to year 2. At the last year, at the end of that year, there will be a redemption value or the nominal value or the face value, right? Right? It's just like your principal. I've mentioned it in the previous lecture, right? So what do you have here? What do you have? Class, figure. Hello, figure.
0.816.
0.816.
0.816. So when you multiply, what do you have?
Should be 86 point. I don't know. It's one. Sorry, wait.
It's 1.6.
31.6. That will be the present value.
81.6.
Okay,
Yes,
81.
81.6.
81.6.
Okay, thank you. So there will be a nominal value at this year. Of course, there will be a face value. See, when you borrow money, you pay interest from year 1 to year 2. At the last year, it is the redemption value, or you can call it nominal value. It's the principal amount. Your interest plus your what? Plus your principal. Although you've already paid the interest here already, right? Now, don't forget that the redemption value or the nominal value has element of premium. Is that not so? So you can say the nominal plus the premium, right? Which is uh
So you are
1,000
mixing it up.
1,000 plus, what is the premium? 18 naira, right? So what do we have, class? 1,000 plus 18 naira, what do you have?
1,080 naira.
1,080 naira. 1,080 naira. So at the last year, right, which is the yield to maturity, will still remain your DCF. Your DCF will not change, right? Don't forget that, class, don't forget that you pay interest year 1, year 2. Is that not so? Now, at the last
Yes.
year, which is the principal, you pay the principal back at the last year. I state an example that I may decide that this interest, I may decide to say interest plus nominal plus premium at the same time. I may do it like that. Is that not so? But for the purpose of you to understand what you are doing, just say, oh, you will pay interest from year 1, year 2. But this nominal is like your redemption, it's like your principal that you will pay at the end of the period. You pay interest year 1, year 2. At the last year, you pay your principal. But now there is a premium. Your principal amount, your redemption, your nominal value amount, inclusive of premium. That is why we say, oh, there is a premium here, which means that that premium, you add it to your principal amount. And that is why we say nominal plus the premium, which is 1,080 naira. Now, the DCF, you just copy it is still the same 2 years. Just copy this and paste to this part, right? You just copy it and paste to this part, right? So what will be the present value will be the 1,080 naira times 0.816. 1,080 naira times 0.816. What do we have? What do we have?
888. 881.28. 881.28.
881.28. Now, you cannot add together. You can see that, please don't do year 0 here, just like the way we number. Please, this is bond. You are looking at this bond in the perspective of the what is it called? Of the investor, which is the lender, right? Not in the perspective of the company, right? That is why you don't need year 0 and all those things that we normally do under the cost of capital, right? So the next is you need to add this together. Class, what do you have? When you add all these things together, what do you have? Add this together, what do you have?
1054.08.
Okay, thank you. 10, 10, 10 what? 4,
1054.08.
okay, 0.08. Now, you can look at it that this this theoretical price that they say you should calculate, that is the market price. That is the market value of a bond. You can see that it is above the nominal price of 1,000 naira, right? It is above the what? The nominal price of what? Of 1,000 naira. And that is what they say you should do, right? You can say that the theoretical price is at premium. Why? Because it is above the nominal price of 1,000 naira. Do we have anyone that have question before we continue? Oh, 10%. Oh, 8 minutes. Wow. 8 minutes. Okay. Do you have anyone that have question? So this is just for bond A. before we move ahead, please. If you have question, unmute your mic and ask. Feel free to ask question before we move on. If you have question, please you can unmute your mic. If you don't understand and you just keep silent, you are on your own. Oh. If you don't understand, ask question. Now, if this is established, before we go, so you do the same thing with bond B. Bond B. Because the question is talking about mention the two bonds, right? Calculate the theoretical issue prices of the two bonds and indicate how many of each bonds Kazari Limited can buy, assuming it invests in only one of them, right? Assuming it's invested in only one of them, right? So let's calculate the theoretical issue price of each of the bond, right? So we've already established that in this, right? So class, it is still the same thing. The only thing that will change. Okay, now let's go back to bond B. You use all these things. What is the coupon rate, class? The coupon rate is what? How many percent? Hello?
12%.
12%.
12%. And redeemable at what? At par. Is that not so? Par means what?
Face value.
Par means what? Par means 100. Is that not so?
Yeah.
Is that not so, class?
It is, it is.
Yes.
Okay. Now, that is the par value. Is that not so? So, but in this question, we were told that for a nominal value of 1,000, they've given us the nominal value we are to use to be 1,000. So if not, we would have assumed, don't forget I say par means 100. We would have assumed 100 and move on. But since the question has say for a nominal value of 1,000, which means that the par value will be at 1,000 naira. So let's quickly just bring out the ingredients for bond B, just like the way we did bond A. Interest. So the numbers of years, the redemption value, or the, you can say, let's say for the purpose of this class, you can say par value, you can use nominal value, you can use slash redemption value, whichever one you prefer, right? You can use it. And it is 1,000 naira given to us in the question. Don't forget that I say if it is not mentioned, you assume to be 100, right? So the interest is 8%, 12%, right? So that is 12 divided by 100 times 1,000 naira. What do we have, class? What is the
120.
numbers of, you say?
120. N is 3.
Okay, 120. So what is the numbers of years?
3 years.
3.
3 years. Okay, 3 years. 120, and this is 3 years. So I think this is 11 o'clock. Oh, okay. Okay. So you can put it in if you can do it, you can just put it in this format, right? Right? Your yield still remain the same. Your yield still remain the same, right? So only that in bond B there is no premium. No premium in bond B, right? And it will remain like this. Your interest, your nominal value, and the numbers of years. Distinguished professional colleagues, we shall continue from here tomorrow. We'll finish this question at least in our next class tomorrow, Saturday's class. Okay, the material. Okay. The material. That's true. That's okay. Tonight I will try to add portfolio theory. So once I add portfolio theory, I will send a message to the platform so that you can have a copy of everything, both the bond valuation as well as the portfolio theory. Right? I don't have solution. No, I will send this one. I will equally send all these things. Don't forget that the class is recorded. You can go to the YouTube as well as to rewatch it, right? So, and it is what it is at the end of the day. So thank you so much.